Welcome back, episode 44 of the Ground Up podcast.
The interesting thing about sheds is...
What? Why on earth?
Business is very busy.
If you're running a business, there's a few core functions that you have as the business owner, right? You've got strategy, it's kind of on you, where you're going to take and steer that business as the captain of the ship. Hiring staff, so roles and responsibilities, systems and processes, and then feeding the beast, which is sales and acquisitions. Those are the functions of where you're likely to find bottlenecks. So stay away from shiny penny syndrome. If you've got a strategy that works, stay on the path.
Why would we not just do one big deal? Why would we do several smaller deals?
5 major completions. Combined, it's £47 million worth of projects.
Is he employed like 40% of Wales?
They then liquidated the other companies and fucked off to Dubai and just disappeared, saying, yeah, you'll get your money back. Yeah, it'll be fine. We'll get it all squared off. And there's no chance of getting their money back. All completely lost because they took off more than they could chew. How many stories do we know like that?
They're absolutely dreadful.
Don't do properly.
Ground up sound. Ooh, yeah. Real estate deals. We lay them down. Let's get those deals. Deals making money, baby.
Welcome back, episode 44 of the Ground Up podcast. We are 8 episodes away from a year of doing this podcast consistently week on week. Very happy about it. If you're a new viewer, then we are 4 property developers based in the UK. We've got £250 million in the development pipeline. Every week we get around the mic and chat shop about business and property. Today we have Mr. Jack Jiggins from the home counties in all his glory. And we've got Dorian Payne, who's our Welsh lad over there.
He sat in Big Brother's chair.
Big Brother's chair.
Comes with the pillow.
We also think you got your 2p webcam in a Christmas cracker as well.
Welsh infrastructure isn't as good as Henley's. We're trying to catch up.
I've got a cool story about infrastructure, actually. It'll be quick, I promise.
Yeah, go on, let's do it.
Apparently there's a famous stock trader that was like multi-million pound turnover every year, really, really successful. And he lived in London and just said, I want to quit. And his bank were like, no, you're the most profitable part of our bank. We don't want you to quit. And he said, I want to quit because I want to move to Canada and just go off grid and enjoy the rest of my retirement. And they basically said, what would we need to do to keep you? And he said, if you can build me a house in this location, get Wi-Fi there, so it's fiber, I'll do it and I'll stay trading. So basically they did. They built them a house literally in the middle of nowhere. They had to run like fiber cable, like hundreds of miles, and it cost them like millions and like hundreds of millions to build them this home.
Why? Because he's so good.
Yeah.
Well, that's a lesson in business, is become indispensable, and you can...
Yes.
The world is your oyster.
The oracle has spoken.
Yes, we don't have Stuart today for everyone listening. He's doing Valentine's with his kids, with Amelie, so he couldn't make it this morning. And you've got myself as well, Ryan Beaumont. So we are all developers, and enjoy this episode. We're going to be talking about this will be very useful for anyone starting out in property as well as those looking to scale. We're going to be talking about scale. We're going to be talking about vertical integration of business services in the property sector. We are going to be talking about all kinds of property strategies, hiring staff, all those sort of things. We're just going to kind of go around the room and pick each other's brains with some of these questions. I'm not going to lie to you. Went to ChatGPT and gave it all the context and went, tell us what will be good questions and topics to talk about in the next episode. And it gave us a really good one. So we're going to hash through that in this episode. So enjoy, and subscribe, man. Subscribe. Make sure you subscribe and share this episode with anyone you think may find it useful. But anyway, before we jump into that stuff, though, guys, are we getting on? D, how's business?
Business is very busy, and it is stressful because we have 5 major completions that are meant to happen. It was meant to happen between first week of January, and the end of March. Combined, it's £47 million worth of projects that we've got planning on them all. We've sold them all to housing associations, and it's just getting them to complete. And we've got a lot of money tied in it, 7 figures worth of capital tied in those deals that's due to come back. just because it happens this way, nothing completed in January, nothing's completed so far, and now they're all still meant to happen between now and the end of March. So it is just insane that we are like, we don't have two pennies, but it's all there, and I'm just push, I'm just wheeling and dealing just to get there. So yeah, that's me a second.
Scale, hey, that's what scale can do. Well, we'll dive into some of that stuff later, mate, and hash out some of those things, because that is quite a common issue, isn't it, for all of us in some ways. You're obviously at a crazy scale, but tying up capital and just going, fuck, I need the money out, I need to move on to the next thing. So yeah, we'll look into that stuff and try and help people who are inevitably going to come across that. If you want to scale in property development, it is just so capital intensive. But Jack, how are you getting on, mate? How's biz this week?
Yeah, I've actually got a question for us later. What I got asked this week, which might be relevant, which is we'll come on to it later after I've gotten a bit of a run through, which is why would we not just do one big deal? Why would we do several smaller deals? But this week, what have we been up to? I went skiing last week, so I'm kind of playing catch up on a few bits. But all exciting stuff, really. We've had delays on a refinance and 2 new sites that we're buying. And the one of the delays is the investor putting he's got the capital and he signed up for it, but it's got to come internationally. So we had a bit of a cash pinch point, which is quite common in business and property. But we've now got our second bank. So we've never bought a bank before. Stuart's old age, he walks around with a T-shirt saying, "I buy banks and take Valentine's Day off work." Those two things.
Yeah, he did.
He's making eggs Benedict this morning. Bless him.
Exactly. Yeah, you can see him in his robe and his slippers, cruising around the living room, the kitchen. But we've got our second bank in legals, so we've had a second bank agreed. So that's quite exciting. I think it will get funded really quickly, which I like. And we've got quite a big land deal that's on teetering of we've countered a new offer, and if they accept it, we're going to have with that, and that's quite a big deal. That's 20 mil GDV.
Is that new build?
Yeah. Rare into the new build space. I see. Plot of land, you say? Well, that's probably another topic we can come on to later. Competitive advantage and why our business is not probably best fit for land deals. But yeah, no, all busy. I really need to hire. I've been saying this for months. A project manager in Central Suites. It's just manic managing the projects in that business, and it's really bad use of my time. Obviously, had the pleasure of seeing you on Monday, Ryan.
Yes,
we
sir.
played a bit of darts.
Bit of darts. Mate, I was quite impressed with how well I did at darts. Didn't end up winning in the end, which is annoying. Jim won, but Jim's got he's got an extra meter of length on his arm to reach the board. But yeah.
Well, I forgot how tall Jim was, because obviously last week, I'm not sure if you've had a episode since, but it was at the National Development Summit as well, wasn't we? Myself, Jack co-hosted it and was MC. And I was there, Stuart was there, and Jim was there, actually. And I remember talking, and Jim just appeared from the shadows from the left of me. And I remember I'm quite tall, and even I had to look up and thinking, wow.
But yeah, sounds good, Jack, mate. Sounds like you're on the right path. How come you don't just get an ad out and get this project manager in, or you waiting for the right time?
No, it's completely on me. The job description's yet to be finished, and it's on me to just go through, finish it, and get it out. My EA has done everything, pulled the job description together, got the Indeed portal ready, and I just haven't spent 5 minutes going. Oh, that's how busy I've been. I haven't spent 5 minutes going through. But that's been this week. It's just been manic. Been in London twice this week, which I try and not do. I try and always do no more than 2 days out of the office.
What was you doing in London yesterday, Jack?
I was in London on Monday and Wednesday, and I had 4 meetings. One with a fellow developer, one with a equity / full capital stack funder, and then another meeting with a social housing consultant that's looking at our social housing portfolio. I missed the waiting list for the Lancaster House Goldman Sachs. Otherwise, I would have seen you present, Dorian, and been the biggest heckler around.
Yeah, I just it's funny. You just said how busy you was. I genuinely thought that was yesterday, but God, it's 2 days since that. That's literally
Friday
it is
today.
just all blowing. But Ryan, what about you? What have you been doing? Skating?
Yeah, a lot of skating actually. Yeah, I love skating. That's a pastime of mine. No skating at all, actually. More paddle tennis. Did play some more paddle. I'm not that good at skating actually. I did it a little bit as a kid, but I was just didn't quite like nailing myself every time. So, but I like snowboarding and going snowboarding soon, which is exciting. But now we've hired a lot this year so far. We've hired 4 new staff members, and wasn't entirely meant to go that way. We were meant to hire 2 of them. So new site manager and new admin for the back office in construction, and then we just hired another site manager and we hired an accountant. We hired the accountant literally within an hour of deciding we were going to hire an accountant. It just happened to work out that one of the girls in the office from our old work had an accountant, and she said he might come work for us, And then she messaged him. I then went in for a meeting with the architects. When I came out, it turned out it was his day off. And so the accountant came in, did the interview whilst I was in the meeting, and left. I came out, none the wiser. And then they said, "Oh yeah, he's hired." And I was like, "What?" We only spoke about this an hour ago. It's all on the vlog as well. And I was like, I didn't know this was going to happen that quick. So we now have an accountant.
Is that what's the sort of scope of work? So is it like bookkeeping?
Yeah, a lot of bookkeeping, data entry, formatting monthly management accounts for all the trading businesses, and then Robbie will work. So Robbie does our accounts full time at the moment with our accountants, our chartered accountants who then do all the filings. But we just want to make it much more slick now. We're at that point where we need those monthly management accounts to be on form.
Data, guys, anyone listening as well, data, financial data, is so important. So important.
It is, yeah. We have like a rough, we have. I mean, as far as most, early stage businesses go, like we've got quite a lot of data. Like we're quite thorough with it. But when you know where you should be and you see where others are, you go, yeah, we need a lot more resource behind the accounts. It's just construction is just such a beast, and how much you need to look at how much data comes into that business every week. It's just like it's a full-time job. So. Yeah, so quite a bit of hiring. Sales funnel smashing it. We are, we're in a very good stead there. There's a lot of scale that we're going to have this year. I can see it already, and it's just how we want to transfer those sales. I don't know, because if we go as aggressive as we are, there's going to be a lot of we're going to need a lot more hires. So I'm trying to think of the smart ways to temper things. So we're trying to
Is this
really
for the
qualify.
Beaumont Training Academy?
No, for investors.
Sorry.
Beaumont Partners. Yeah. No. This is I don't do the academy stuff. We just got the Ground Up Network now. So make sure if you're out there and you listen to this, go check out the Ground Up Network. Links in the description.
Ground Up Pod.
But yeah, no, just our investor lead funnel. We've had 3 investors close this week, 2 of which closed in 3 days of call, and we've just got about 50 in the hot pen. And it's just like we need to resource the acquisitions more. So it's just it's quite a bit going on.
The pool of obviously all these investors and the funnel to bring in more and more and more investors. Even I'm thinking where the patch in terms of you doing deals and for I mean. How is that going? Are you running out of opportunities? Are you over condensing in certain areas? Like how are you managing that?
We basically pick strategic locations. So whenever we're doing the acquisitions part or sourcing part, the number one thing is location, and we base location on demand. So what demand is in that area for the rental side of things. So we've weaned out places over time, really, based on performance. So we don't do any in Darlington anymore. So no HMOs in Darlington. We stay away from certain other areas in the Teesside region. So we focus more on the Tyneside region, where there's over 1 million population. There's still a lot of opportunity and huge growth in the jobs market. So as long as we're in key corridors between the metro lines from the Tyne to the river, from the Tyne to the sea on both sides, then they'll rent all day long.
Are you still doing just HMOs or buy-to-lets as well?
So we're doing buy-to-lets now as well. Yeah, HMOs, buy-to-lets, but also commercial to resi. So we've sourced 2 of those already.
For investors.
And for investors. So yeah, we're just building out that funnel, that funnel that we and that pipeline that we wanted.
Must be a
funnel. Yeah,
must be
it's a combination of funnel and pipeline.
Funnel. So, I like that.
Let's trademark that panel.
How's your panel? My panel's good, mate. You heard it here first. All right, Ground Up.
Just real quickly on that, I was actually going to share my screen on something here. We're talking about location. So when selecting our location for our HMOs, and you can do this for buy-to-lets, we essentially do like a heat map on certain like moving metrics. So we start off with population, whether we're considering that area, drive time from the office, room rates on the rental rate of a 3-bedroom house, room rates on the pound per square foot, the average asking price, the average pound per square foot, the average sales per month, the turnover sales per month, the asking rents, the yield, the 3-year growth, the household income, the social rent, spare rooms wanted, so people looking for rooms against spare rooms vacant, and then a ratio of saturation. And this is the data that we pull to select a new location for HMOs and buy-to-lets. And I just thought that would be worthwhile sharing, because you're basically talking about that. But like, all of these areas are within our Central Suites patch, which is basically West London and home counties. And yeah, we go to this much detail to determine where's next, essentially.
So could you just run through an example there of what a bad location would look like, and just explaining why based on that data?
Let's start. So this is currently ranked heat. So the beauty of this is you can rank it to the weakest to the strongest in any category that you want. So obviously, if you're buying in a high pound per square foot area, your capital appreciation and market robustness is going to be stronger because it's a valuable area. If you want better cash flow, you want to go to a lower pound per square foot area. But always the essential thing for HMOs that we look at is the actual saturation point. So let me give you an example of that. I know that this top location, I think it's actually Twyford, and they've got 2% coverage of people looking for rooms. So there's 6 available bedrooms currently today. Well, when this data was done, which I think was middle of last year, there's 6 available bedrooms to potentially 380 people looking, which is an amazing ratio to build a portfolio in that location. And second to that, this bottom location, which I think is Swindon, for every one person looking, there's 1 room available. So you've got to be better than the market to let your room. So if you, to put that in perspective, let's say there's 100 rooms available and 100 people looking. For you to let your rooms, you've got to be in the top half or percentage quartile of that space. So, and that's quite difficult to keep up on, from branding, marketing, your team being efficient at follow up, and actually competitors coming into the market and doing brand new refurbs right next door to you, and you've got to compete with that. So we like sort of quieter areas and being the sort of monopolizer in that area and owning the market. So we focus on the less saturated areas. A lot of people that get pushed through a Simon Zucci course, they'll say, is there a university? Is there a train station? Right, that's where you invest. I completely disagree. I couldn't give a monkeys if there's either of those things. I would rather a population, because then you know that there's going to be a demographic of young. We only work in young professional space. There's going to be a demographic of young professionals renting, and then if supply doesn't meet demand by a significant way, then you can tackle that way. So to give you an example, Abingdon, which is our location that we operate in, when we started looking at it, it was like 1 or 2% saturation against when we moved there. We've now got over 100 beds there, and it's now way higher, and the supply is now matching more demand. So it's not a good place to go to now, because we've already supplied the demand, and that's why we branch into different locations. But yeah, this is the data that we go to.
This is great data, and this is exactly what people should be doing when considering an area. And this your locations are also very, the commuter areas into London as well. So I kind of agree with what you're saying, that it doesn't really matter as much about universities and all that sort of stuff. It's just because there's something else major going on. But why have you, just for the audience benefit, why have you considered, in terms of the yes, on the one at the very bottom that's like 44%? What's the story behind that? So I understand the top ones, but why are you also considering that bottom one?
Yeah, so that bottom one is, I believe, is probably Maidenhead as a guess. I actually need to pull up my full data, which is Doran's favourite place to visit. A few years ago, Ryan, Doran was like, "Hey mate, coming into London on Tuesday, do you want to meet up?" And I was like, "Let's do it. Where do you want to meet?" And he was like, "Maidenhead." I was like, "Cool, let's meet in Maidenhead then." So we both met in Maidenhead. And he was like, "This is cool round here. This is a nice patch." And I was like, "Yeah, it's all right. I mean, it's fine." And I was like, "Yeah, I parked over there." And Doran was like, "Why'd you park there? I thought you lived in Maidenhead." I was like, "No, mate, I live in Henley-on-Thames." So he just thought I lived in Maidenhead. So that's why he said Maidenhead.
And he didn't.
It's Maidenhead's very different to Henley.
He just turned up on his chopper like, the disrupting the entire street of Maidenhead on his Harley motorbike. And I found out later on that he didn't even live there. So look at that. But we
Maidenhead
both
is
got to see a bit of Maidenhead.
it's an interesting town, Maidenhead. Like in terms of its redevelopment over the last, say, decades. Like it's really like the town centre. I think because of Shanley, wasn't it? Shanley Homes. They really
Yeah, Shanley have done quite a lot there. Yeah, I believe that is Maidenhead, and the reason that we would consider that there's always rules of thumb that you have to override. So, for an example, we don't like operating in areas for HMOs that's under 15,000 population because we don't feel that there's enough of a population to feed the rooms. That said, the top one, which is Twyford, we would because it's got surrounding towns that are much larger than 7,000 population. So you will get people that commute in and out of Twyford in neighbouring towns such as Reading, Caversham, Maidenhead. And then from a saturation point, Maidenhead's just such a robust market. It's like something like 16 minutes on the train to Paddington. And even though the saturation in Maidenhead is 44%, people can people can be London commuters. Like it's almost easier to live in Maidenhead than it is within the M25 in another location because you're in a much more affordable location. So that there is always gut feel rules of thumb, and the only way that you get to know those is actually everyone always is like, "Where's your gold mine area?" I think that's absolute fucking bullshit. I used to invest where I know, and where I know is where I know, and you know that road is not as good as that road, and this area is not as good as that area. And actually, deals do work in the bad area, but you need to buy it right, and you need to have the right strategy behind that. So every single one of these locations, I've sort of like lived and breathed it. I know people from there. I've been there. I've been around the town. I might have played rugby there one day. I know these areas inside out. So that we will always create a gut feel as well as all this data. But the data, without the data, it amazes me how many people go to invest in new areas without any data. And the beauty that we've had with investing in Abingdon is the values of the property prices have gone up since COVID because people can't afford Oxfords, they're moving out, and now we've got something like 80 beds coming to market in Abingdon in the next year, and that'll probably be the point where we're like, okay, this place is done. Like we need to focus on other areas now, and we're still tracking that. We've got 7 years of tracking this data crystallized at the time that we tracked it, so we can also see where it's moving to as well. So for listeners out there, you can get all this from Property Data and Spare Room and Google, and that's all you need to create this.
Nice. Oh, I'll give you now you've shown that, which is obviously very comprehensive, showing all these different data points. For us, what we the data we take from is from the lettings business, where every month we'll do a full group meeting like with all the departments, and then lettings will just spiel off like the average room rents in all the different locations that we operate in. And then we do a separate meeting with lettings just to see what areas are working, like where are you renting stuff quickly, where are we seeing a lot of renewals and things like that. The benefit we've got with up here in terms of values is almost every area we operate in are very similar square foot values. There's not really a massive swing. But also in the Newcastle corridor, there's 2 main metro lines that go from the sea to Newcastle city centre. And we basically follow those Met lines either side of the river, and we just work between those, other than in some towns where we know there's major employers like Thames Valley and stuff like that. Now, I've never crunched the data anywhere near as hard as you've crunched that data there, Jack. But I do obviously look at Spare Room to sort of keep up to date with what the saturation levels are like. But a lettings business also just helps with that, which I know you've got in Central Suites. Like just that's the facts, isn't it? When you've got the facts on the letting side, and we dropped a HMO there recently, and it literally rented out within days. You know that okay, well from experience, that's definitely still a good location. And then you have some that start slowing down, don't you? And you go, okay, got to be careful of that area now. Let's move away from there.
Yeah, interestingly, a lot of people say to me, like mentees or people moving into the HMO space, they're like, how do I know this location works? You can look at all the data all day long. And actually, there is an element of like theoretical and practicality of like boosting the confidence to let a building there. But our first HMO, the way that we de-risked it is we bought a house for 270. We spent 50k on it, refurbishing it to a 4-bed, 4-bath HMO. We knew that we could probably sell that house for 375 as a family home within a few months on that street. So we knew that we'd bought well, refurbished well, obviously to a good standard, And if it didn't let, we could sell that property on, make a small profit, and move on. What actually happened is we let it in 4 days, and we're like, cool, let's do more of these. And that was, the catalyst, the boosting the confidence to just keep going and going and going in that location. So there are other ways that you can protect it from what I would call more like an old school way, where you just protect your downside, actually fill it, advertise it, fill it. Obviously, dummy ads is quite a good way to gather interest.
Naughty. Hopefully helpful for anyone out there listening, looking at HMOs and stuff. I know Dorian gets so bored when we talk about HMOs, doesn't he? He's like, HMOs are boring.
No. I think it's important because I used to have HMOs and I still have a portfolio of buy-to-lets, and I used to have a letting agency again years ago, and we used to manage HMOs, and I've also been involved in SA. And when you're into those kind of property investment models, data is really important. So I find it very interesting because eventually one day I'll probably end up back in that space. It's just when you end up in development, it becomes so capital intensive. I mean, Jack always impresses me how he's really able to keep and scale the momentum of the size of his development operations, as well as still scale his investment portfolios. It's not something that I was able to do. I've had to liquidate effectively and focus my entire efforts on the development and trading business model. So that's really impressive. But I find it interesting in the development space. If anyone's interested, if you're doing partnerships, the data you get really is from your clients. We're client led. So housing associations and local authorities. Obviously, there's some public data points, but to be honest with you, they're the ones with the real list of waiting areas and areas with grant support, things that you won't see in the public domain. And they're the ones that say that this is the areas we're really looking for. If you find any deals in this area, this size, we'll snap your hand off for it, so to speak. And then you can focus your land criteria to focus on those.
Well, it's a good segue that, because Jack, you were saying right at the start about how you don't think XP is necessarily built for land deals. Do you want to just expand on that and give the viewers some context as well, just about what you usually do?
Yeah, so I'm very bad at a lot of things in the property development cycle, but the thing that I seem to be more naturally gifted at is acquisition. So buying sites, whether that's land or whatever, HMOs, land, commercial buildings. And I always say to anyone that I'm trying to help them find deals, because it seems to be the biggest issue in private development, in SME development, is finding the deal that works, because there's so many people in this industry. Like every day I see a new business pop up on Instagram and I'm like, not another SME developer. They're all looking for deals and we're all in the same patch and we all need to fight for projects. And I always say the best way to get a deal secured is to understand your competitive advantage. And what I mean by that is if you have for example, a contractor developer, so like a Stuart, so he runs a construction business, and he's now going to development. But let's just assume this contractor developer is better at new build, which we have tons of them around where I live. And we're both bidding on a land site. They can build at £150 a square foot all in. I need to instruct someone like them to build my site for me because I don't have construction in-house. So they're probably building at 150 plus contingency plus margin. So let's say that's 180 a square foot. What that then means is it compresses the land value for me down because I'm having to pay a contractor a profit to build that site out. That's always the way that we will operate and how we choose to operate. And I'll come on to why that is important for us from a risk perspective. Secondly, Ben's design nous and understanding. So that's increasing gross development value through design and decreasing costs by value engineering design. And in those two catchments, if we cannot create more value than the contractor developer in his build value, we cannot compete on that particular part of that site. This deal has actually come around via probably more the acquisitions and networks. It's been brought to us by someone that has the deal but doesn't have the funds. So that therefore our competitive advantage in this situation is having a network of backers, basically. Our competitive advantage in this situation and how it's presented itself. Now to come on to like why we don't have construction in-house, and we talked about this quite a lot with Stuart, is we are live on 5 developments today. We have 5 different contractors, one on each site. All of them are independent businesses. All of them have independent build forces. All of them have independent balance sheets and P&Ls. And we like that comfort to know that if one of our projects goes west by result of the contractor, it protects the other 4 and we can deal with that management from a risk perspective. to still deliver that scheme, hopefully as best as it can do, by either porting over a new contractor or bringing someone in. Porting over an existing contractor or bringing someone in. But that setup of what we have and are has naturally pushed us into conversions and made us way more competitive at dealing with conversions. And the reason being is the first bank that we exchanged on in January. I was on the phone to so basically the insurance came back eye-wateringly expensive because they've put in the size of the building on a insurance calculator to work out its rebuild valuation, which is what a building costs to rebuild it. The insurance obviously want to cover that because if it burns down or crumbles, they need a budget to rebuild the building and put it in its original state. They were quoting about £600 a square foot to rebuild this building, which I'm challenging, obviously, because that's just, it might as well be in like under the Antarctica to build something for that, or on the moon. We are saying that it will probably cost about £300 a square foot, which is £1.8 million. We are buying that building for £800,000. So that is why we're more competitive at conversions, because we're buying a building that no one can replace it for the value we're buying it for. So we're converting an existing superstructure. I think we've paid something like probably about £100 a square foot or £120 a square foot. It's impossible to replace anyone to replace that building for what we've paid for it, actually also in the location that it's in. So that is our competitive advantage, buying good location buildings at cheap fabric costs. So we're getting a big shell for really cost-effective pricing. And then we're being really bitty about how we manage that. And on top of that, we're trying to sell the ground floor for 425. So we're actually going to get office and 3 flats for about 400k, which values it at like £80 a square foot. So that's our competitive advantage. Everyone's different. Everyone, you might come from a construction entity like Dorian, and you might actually be able to compete better on land sites. I wouldn't fuck around with buildings. You might have a architectural practice, therefore you need to be working in planning and uplift, and in that space of value add. You might be an estate agency, and then I would believe your value is acquisitions and exit. So it's analyzing your competitive advantage where you can add value. Like I've met a lot of engineers and consultants that work in construction, and their value add is actually taking on really tricky sites. Like there's a site in Reading at the moment where it's got planning consent to build a massive building next to the canal. Now that is a really complicated build, and there's probably huge cost infrastructure in that deal to deliver that. But if you're a aquatic structural engineer specialist, you'd probably get your teeth stuck straight into that and save a huge margin in that build cost, and that is your competitive advantage.
Yeah, it's great advice, mate. It's great advice for anyone out there to identify.
Excellent advice.
I haven't touched on one more competitive advantage, which is funding. Funding. Some people just have really good funding, so you might be able to. We know a mutual friend developer, third generation. They've got a credit facility with, I think it's Lloyd's, for like 10 million. It's as cheap as chips. He might not be adding value across any of the board, but he might just be bringing in cheap finance, and that can also be a competitive advantage. I mean, the list goes on.
Yeah, I mean, there's nuggets for everyone out there. I mean, so what would you say to someone who doesn't understand or even potentially have a competitive advantage because they're green as grass, they're starting out, they come from a completely different sector? What would you say?
Give me an example.
I'm from, I was in accounts or something like that. Or I was not going to say data analyst, but, I was someone in admin, like say admin in London, making a fair whack. I was making 70 grand a year, and I want to change career path and I want to become a developer.
So semi-financial background, I would say, if they're accounts and probably a high volume business, a high transactional business, maybe like service accommodation or HMOs would suit their personality better. Realistically, I can guarantee that person, if they even have 20 Facebook friends or 20 Instagram friends, they've probably got a connection that could be rooted into some sort of competitive advantage within property. So, for example, I was brought up in a family of builders, so I knew tradespeople. I had people that built houses before, so I could lean on their expertise. So it's about your network strength. And then if they're probably quite analytical and data driven and bookkeeping wise, they're probably quite a good learner from a highly monitored metrics business. which is really, really important and invaluable. They probably understand the finance and the capital stack better than others. So, for an example, if I was in accounts and admin in the city, for an example, I would throw myself into understanding the numbers behind what is the capital stack, what is equity, what is a IRR, what is an average rate of return, what is a hurdle, build those relationships, work with lenders. You could probably, I would say, a good starting point would actually be to look into going into the unregulated brokerage market and be a broker for unregulated products. So development facilities, refurbishment facilities, bridging facilities, build a reputation, start working, start doing deals. You get paid 2% of any loan that you instruct. You're meeting new clients, you're meeting new people, you get to know the lenders, you get to know the developers, you get to understand the schemes. Do a few years in that, and then once you're in that and you've got a bit of cash behind you, take the punt and leave your day to day. Hire someone in to do the pushing of the loans on the day to day basis, and then start doing deals. And a good friend of ours, Stefan, who's a broker, he's now doing like deals himself with borrowers, and he's gotten himself into that space by starting in the unregulated brokerage market. And that advantage, starting out with accounts and admin, would be really, really effective in our space.
I really like everything that Jack said there, and I'm a big fan of business theory, and finding competitive advantages is something I've spent a lot of time doing and whole modules on, actually. So I think it was absolutely golden advice for anybody listening, and just save that sound bit down really and re-listen to it for motivation. So, but to come on to the question, I know it wasn't asked to me, but I want to chuck my opinion in the ring. Someone like semi-financial and admin background, they could bring a great competitive thought process to which will drive a competitive advantage. But I would think that anybody, because I've got a financial background, accountancy background, and the one thing that I tried to do as early as on, and which is probably what they would do as well, is they would spot the kind of the financial fundamentals of a business model and look to create a structure with like positive working capital cycles. Like if you look how I've tried to scale this business, I've tried to model it in a way where it's a positive working capital cycle business with a self-sustainable growth rate itself can be very high based on the business model in itself. And that's the type of thought process that they would end up bringing to a business, and they would probably be very cash flow protective, a bit conservative. They would play the long game, not so important about the short game, and be in like shiny penny syndrome potentially. I mean, and that over time, because that's the thing, it's more of a medium to long term play, gives you a very, very, very strong advantage, whereas others who make short term quick decisions and they've not planned the model and they're not following, they're not like on a track, so to speak, they're following a plan. they're much more susceptible to market swings and can get knocked off course a bit easier. So, but it comes back to what you said there, Ryan, about employing an accountant. Those with the data, and what Jack showed as well with his, those with the data and with fundamental plan backed with evidence, over time, statistically, will be the ones that outperform. May not happen in the short term, but in the medium to long term, it will.
They say if you can't measure it, you can't manage it, right? So very importante. I'll throw my hat in the ring as well, just because I think I'm a good extreme example of coming into an industry without any property experience whatsoever, but a clear skill set in marketing, and then my dad having a clear skill set in sales to investors for a different kind of product, and we used that. It took us a couple of years to figure out exactly, which is another point as well for just adding on to what Jack said. Sometimes you think you might have a competitive advantage starting out, but your strategy maybe doesn't quite align because you don't understand the industry that well, and then you kind of find a sweet spot and go, oh, that makes a lot of sense, we should be doing that. And for us, that was doing a full stack service for investors, because we're good at marketing, good at sales, and we know we can get eyeballs on us. That was my experience in the band before the attention economy, we knew we didn't have enough property experience to be going into massive deals. So for us, it was volume, sales and marketing, keeping a low risk on our development projects. So identifying and knowing our weak spots. But it still took us a couple years to figure out actually what the right strategy was from a business perspective, not necessarily from a property perspective. We're still doing HMOs, still doing commercial to resis and buy to lets, but the actual business strategy was, rather than just doing that with our own money, it was actually to create a service for others. So I think there's a bit of nuance there, isn't there, between property strategy, then how you build a business case around that, which ties into the next thing, which Jack, you brought up earlier. Why don't we just do fucking big projects? Why don't we just go all in and do a big one and save the headaches? So go to D first. D, you do big projects, but I think you could do much bigger if you wanted to. Like you could do 200 unit schemes, but
I mean, technically, our projects, I know what you're saying, but in the development world, they're actually classed as small still. It's, when we say, like, there are some really big projects out there. And I would, it's a funny one because there's a lot of people I meet that really want to do a big project, and they're great if it goes well, but if it doesn't go well, then you can't really trade out of it. To be honest with you, it's game over. It's kind of like bet the house, so to speak.
that's it, innit? That's it. That's kind of the answer.
Well,
That is it.
it is one answer, and then also I was given some feedback from somebody who worked very closely with an entrepreneur who scaled a business and has become a billionaire, and I was speaking to them and kind of asking for advice about my business and all that sort of stuff, and I told them my story, and yeah, they're very, very complimentary feedback, which is great, but he did actually give me one potential risk of everything I've done to date, and he said that the biggest risk that I've got for going for me is that I'm too experienced, too qualified, too kind of knowledgeable in a way. And he meant it as like, I've invested a lot of time and effort into theoretical learning as well as practical learning, and I'm very much like that. And anybody who know me will agree the same. Whereas, like the entrepreneur that he was talking about, the one that's become a billionaire, didn't really have industry knowledge, didn't really invest, hasn't done a master's, hasn't done learning, doesn't read really many books. Is just bam, does something, make money, doing deals. Yeah, I can do that, do deals, and maybe a little bit of luck as well, but it worked out. My problem is I know straight away like when I speak to some developers who want to do a big project, I'm like straight away, well, the one issue you're going to have is, even if you manage to find the deal first, it's going to do like 100 million GDV. How the hell are you going to get involved in that as a principal developer? You're not going to be able to raise the finance. Your PG probably isn't going to be even on the cap, a PG cap. You're not going to, under financial DD, you're not going to get through. So, and then by the way you carve it all up, the only way to end up in those types of deals are like a promoter type structure. You end up with a minority stake in something big because you're bringing in different types of funding, and that's how they do it. And that's the problem with me, because I know in theory some of the key steps. That puts a bit of a limiter in, doesn't it?
It's essentially saying naivety is sometimes your friend.
Yeah.
A blessing and a curse. Completely agree with that.
Unless you bet the farm on it and then it goes wrong.
Yeah.
Then it's not so much your friend.
My answer, though, was the first one. The reason why I don't do really big deals is because it's actually, there's two answers. One is because, I genuinely been in deals that lose money. And if you do it on a small scale, you can trade out of it. If you do that on a big deal, there's no way you're trading out of it. The second one is genuinely because we're client-led. We can't do a deal too big for us. We will not get the permissions. We will not get the approvals. I've been in it before with raising development finance where I didn't meet the PG requirement, and it does cause a problem. And I've also been in it before where we've taken a big, large site to a client and our company doesn't pass the credit check for that size of the job, and you can't do it. So that's the problem. I see some developers, they spend like 2 years trying to do a massive deal. They ignore all small deals. They've never done a deal before. And only once you finally get that deal and try to get it through the door, do they tell you, actually, we're not giving you the money for it because you're inexperienced.
Yeah. Well, Jack, how would you answer it? What's your cookie cutter answer to why not do big deals only?
The individual asked me, why don't we do bigger deals? And now I'm essentially just an old labourer that grew up around Oxfordshire and knows how to carry blocks around site and can do most things on site, where Ben has a professional experience working for the Berkeley Group and managing teams to deliver 960 flats. So we're probably almost in our network in one of the best positions if I'm not on site to deliver larger sites, 50, 100, 150 unit schemes. Ben is really comfortable in that space, like triple, he's dealt with triple story basements around tube lines in central London. That's also got to deal with water retention of the Thames and things like that. So, from a technical perspective, we're probably quite well equipped. The way I see it is actually similar to like the Boston Matrix, where you have like your cash cows and you have your star projects, and then you have your question marks or dogs, where not every project is going to go right. One of our backers runs a £90 million fund, and he does about 60 development deals a year, where he puts in the mezz, the equity into development deals. His rule of thumb is 8 go well, 1 might go wrong, and 1 might be all right. And that's kind of like his model. And that is a model of diversification and differentiation. You will have some schemes that have unexpected changes. There's a site in Henley-on-Thames that Taylor Wimpey bought for over 100 units. The site has been stagnant for 7 years because of underwater, it's basically like an underwater stream that runs to the River Thames. Now, that's an extremely large outfit that should have had their pre-commencement trial digs and all of that like pre-con stuff dialed down. But that site is going to lose them money. Probably, I know they paid £20 million for the site. That's probably worst case. They'll probably lose 20 million plus the profit and the finance. Or they might eventually get on site and build out and try and recoup some of that loss. Now, that is a huge outfit. So what is anyone out there that's doing 5 little piddly 3, 5, 6 million GDV schemes going to have against a big outfit like that have the team to investigate sites, to get on site as best they can? So our view is we deliver about 5 sites a year. They range in values between 3 million GDV and 10 million GDV at the moment. And not one of those schemes could drag down the other 4, or in actual fact, not 2 could drag down the other 3. So for us, it's all about diversification. It's not trying to, be the ego builder that you want to be. So for an example, let's say you had the opportunity to have 1 child or 5 childs. If you have 5 kids, you might have an athlete, you might have 2 intellects, you might have an artist, and you might have one that's a retrobate. If you have 1 child, it could be any of those 5. So we like to counterbalance that risk in delivery. And that is exactly why we do multiple little schemes. And I touched on earlier that they're all self-funded within limited companies with their own construction firm delivering it on a fixed price contract. So our actual risk, once we've got all of that in place, is fairly low.
Just to add on that as well, there's something in the investment world called the modern portfolio approach or something, where it's to do with risk mitigation and diversification. Whereas, like, if you have 1 deal, 1 stock, 1 business, your risk is massive. And then it's about diversification, but you don't diversify endlessly. After you get to between 10 to 20 different diversifications, the benefits diminish. Because I found that interesting. It's kind of the same in our business. We're on live right now on 10 live sites. We have 1 job that's losing money, and we have 1 job on the upper end that's making a very, very great return. And it's kind of like that. What's that maths thing again? It's the curve, the bell curve there, where you have the extremes and then the average. I forgot what it's called. This anyway. Someone listening is probably going to be shouting at the screen. But anyway, you don't want to have the only deal you have being on that worst case scenario. Do you know what I mean? That will set yourself up for a hard time. Also, I'm trying to scale a trading business with a trading business valuation. You can't really do that with just 1 big deal after the other. I'm trying to build a pipeline, contracts, get into frameworks, have lots of deals, lots of cash flow coming in, and build a valuation where, like, the PE firm or a competitor says, I'll buy that for X times earnings because it's sustainable, consistent,
Yeah.
I've got to take my kids to school. Very sorry. I will catch up with the rest of your comments, but school duty, guys. Sorry.
No worries, geezer. All right.
See you later, Daddy.
Bye, Daddy. Yeah, I'll add an anecdote to that, Jack, as well, because it's funny we're talking about big sites, because our architect was in the office, and they're from Yorkshire, and they were talking about a really reputable developer in Yorkshire, and they'd built up the same way we have, went from like HMOs to doing small apartment schemes to larger apartment schemes to bigger and bigger, built up a great reputation in the Yorkshire area. So much so that they got onto pretty big sites, quite significant sites. And then they took it kind of a step further, and they had 4 big sites on. One was this like straightforward, like a load of new build apartments that they're building out to sell and retain some. The other one was a huge conversion in the town centre of York, which, if you know York, is like, that's an ambitious feat because of the listings, and it's crazy to get around all the permissions there. And another one was to move a gas line from an old, like, the old gas cylinders, like that would the gas towers, and there was a gas line underneath it, and they wanted to move it to realize the land opportunity underneath. And they raised 20 million from investors for just that one. They had about 10, 15 million in some of the other sites. They then just could not get the permission to move the gas line. It took them years to do it. They pulled out a bridge to try and fund some of the shortfall because the costs were ramping up and up and up. And then they realized when it came to actually moving it, the cost would be nearly double to move that gas line than what they forecasted. They thought it'd be something like 6 million, turned out to be something like 12 million. That then took down that scheme. There was no way for investors to get money back. So it took down that scheme. So what they did, this, bear in mind, great reputation. They then liquidated the other companies and fucked off to Dubai and just disappeared, and they're basically talking to investors back here saying, yeah, you'll get your money back, yeah, it'll be fine, we'll get it all squared off. And there's no chance of getting their money back. Some investors will be able to recoup through the courts on some of the other schemes, but the 20 million that went into the gas scheme of moving this gas line, all completely lost because they took off more than they could chew. And that's just how many stories do we know like that, where developers just took on that bit too much? Developers with a lot of experience as well, but they just concentrated their risk, and then one domino comes down and the whole thing comes down.
Yeah, I mean, we're trying to spend every year de-risking and getting less, because the slightly larger deals, we were doing end of terrace houses, 500 to a million GDV. They're actually probably more risk associated with the return and the time and the cost of the trading entity than a slightly larger deal like 3 to 5 million GDV. But yeah, we're all about multiple, 2 to 5 deals a year that are all similar sizes and manageable, and the construction is split out on the risk of that. Obviously, there's planning risk, and actually the biggest risk for us, which is not necessarily like a glaring risk, is time delays with Thames Water. They're just holding up every fucking single site we've got, and it's upgrade. So killer. They, like one site, they're quick, connected, they haven't delayed anything, it's all lined up. And then you and that project will take 15 months to deliver. Another site, they've delayed it 15 months. So from the point we thought we would be done, they're 15 months later.
Just to fit the new water supply?
Yeah, they're absolutely dreadful.
Well, Thames Water's been famous for having private equity coming in and stripped it of all of its equity, and then they're running on fucking thin ice.
Running on water.
Literally. Well, let's look at let's maybe jump into some of these questions and then do a closeout. Oh, Stuart's just sent some pictures of his kids and their Valentine's breakfast. He is cute, isn't he? ChatGPT is giving us some interesting questions here. So first one, I think we can box this off fairly quickly, but navigating the changing property market, what's working right now, would you say, Jack? What kind of advice would you give in that sense?
What is working? Property development is a hard space, and I think it's very regulated. There's lots of assessments that surround it. It's very difficult to cash flow. I would say that it's difficult to get into. I think it's good in a way if you're already in it and you've already got infrastructure in place, because it makes a higher barrier for entry. And if you want to get on your onions and manage that barrier for entry, get into the ground up network. I think the buy-to-lets are really difficult to make them work in the south. So if we build a block of flats back in the day, we'd be able to hold those and refi those and take quite a good income. Even if we've made loads of profit in the delivery, we can't do that anymore. It's just not worth keeping. You're basically keeping equity in a portfolio just for capital appreciation, which is technically a variable uplift and an unpredictable uplift. So if there's no cash flow, get rid of it, is our motto at the moment. So out of the 70 units that we're delivering today, we're selling pretty much all of them. The only things that we are keeping are HMOs, where the cash flow is worthwhile keeping, where you're getting a higher rent roll cash flow. And we've actually adapted a lot of our HMOs into some of our developments. So pretty much all of our developments that we're delivering, apart from the luxury scheme in North London, has HMOs within the development. So we're selling a load of flats. So the old Maltings, we've got 21 flats and 2 houses that we're developing on that whole site. We're keeping the 2 houses as 5-bed HMOs, and we're keeping 3 flats as 5-bed HMOs and selling everything else so that we get out of that scheme. So that adapted strategy is something we're capitalizing on. Commercial is still a bit dry. Like selling commercial buildings and a yield is dead. Like our social housing portfolio, the market is recovering. To put it in perspective, we had sold our portfolio at 5.5% net yield in 2022. Now you'll probably be more like 7% net yield. It's starting to come back down. The worst of the market, we saw it like 8.5%, 9%. And that is because confidence was dropped. Cost of capital was higher, so therefore they have to buy it at a higher yield to make a margin. And obviously the government changes that we've been through. So I think that yield market is going to get stronger over the next few years. So if you can get in at a 9-10% net yield with a bit of value add on top of that, I think you'll do quite well out of that particular stock. What else is good? Banks are still a fucking pain in the ass. I find that they're like absolute hillbillies in the market. They're calling the shots. They're really wearing the trousers at the moment. And we're in a market where it probably is a buyer's market. But I always like to think about the lending market is a borrower's market or a lender's market, because there's normally a race to the bottom. I think it's still a lender's market. They're walking all over us. They're being difficult. They're delaying things. They're saying they'll do this and do that. So be very cautious with who you're going with from a lending perspective, and that you have a relationship with them. But I'm still seeing investors in the market space. So to encapsulate all of that, developments are tough, commercial shit, but there's obviously opportunity out there. Building is obviously hard. Like we actually got a quote with our like most trusted contractor that we've worked with over and over again to do a 7-bed HMO, and the quote came in at 220 without even like kitchen or fixtures and fittings. And that is on the same street that our first one cost 45 grand. And that's only 7 years ago. So it's basically 4 to 5 times the cost in 7 years.
And that's no furniture.
And I actually believe that he's not taking a piss on that. That's no furniture. That's nothing. And I'm like, shit, we're going to have to do something with this one and bring that down. Build costs are high. You know,
bring construction in-house, Jack. That's what you got to do, mate.
I don't think it would be cheaper. He's very cost effective. Yeah, he doesn't really charge for his time on site managing the projects, so it wouldn't really be. It's essentially, he kind of cost me the same as if he worked in house for me. If I had him managing the trades, it would cost. I think it would cost about the same. So yeah, build costs are high.
I think to assess the property market in the UK in a time where, like, looking at strategies that work in a time where we've had crazy levels of inflation across the board, suppressed land values because of just crazy government regulation and planning being an absolute ball ache. I think you have to start thinking of your strategy more geographically than actually just the strategy itself. So if you want to retain stock, like you say, good luck in the south. There will always be pockets where you can, and it's finding those pockets. But that's still geographic. Now, if you want to trade sites and resell sites, then you want to be in the south and not necessarily in the north. So I do think there's quite a geographic element now, which we're kind of seeing. I feel like we're kind of seeing the UK sort of fractionalize into areas where certain strategies no longer work and certain strategies do work. Even like house buildings, house bashing in general, the cost of build now compared to land values is so crazy that I don't know how developers in the north make it work unless they've got huge numbers on the land, and they bought the land 10, 15 years ago, which basically limits it to just your big boys. I don't know many developers up here who are SME who are doing many house builds unless they're in just those micro pockets where it's a really good town centre, or like a Richmond or a Yarm kind of area where your average house value is 500,000 compared to the average house value up here, which is more like 200 grand for a new build house. So I do think geography comes into it quite a bit nowadays because of the kind of exacerbation of material prices and things like that. It's something to think about for anyone getting into the space. This is what we did as a business. We want to retain stock and build cash flow, and this is back in 2019. And we realized at that point, well, the only way to do that is for us was to go north or to adopt a slower strategy and do things in the south, knowing we'd need much more capital to move sites on. So yeah, I'd say geography, but I think all strategies still work. Maybe I'd stay away from commercial office buildings. I know we know a couple guys doing that, but risky to me trying to get into the office market at the moment when there's so much stock on the shelves it's not shifting. Sheds, things like that. Maybe there's untapped stuff there. None of us boys in the Ground Up Network touch the Ground Up podcast touch that sort of stuff, but there's definitely There's definitely money to be made in key like Freeport locations, key industrial locations around the coastlines of the UK, where there's a lot of big institutional money coming in, trying to sweep up data center locations, fulfillment locations. So knocking up sheds and stuff, I'm sure there's still a relatively good yield in it, but I don't think it's going to be better than resi. I don't know if you've got an opinion on that, Jack.
Yeah, I think the barrier for entry on sheds. I'd love to be building sheds. I think they're such a robust, required, needed. So what we're referring to as sheds like industrial buildings, where it's storage or industrial use that are typically outside of the locations of city centres, because realistically, most of those sheds will probably be converted to other uses or resi. I'd love to be in that space, but I feel like to be in the shed space, you either need to be able to be really good at locating the sites to create them, or you need to have really good funding, because it's a very competitive space, and it tends to be the larger players that have an arm. Let's say they have a resi arm and a commercial arm, but they're borrowing at 5.5%-6% on the commercial. Therefore, they can knock out these big warehouses. Whereas for us to take on a £30 million shed, the difficulty isn't building it. It's actually really straightforward to build. It's finding the site and getting the capex to do it. Because if we went to a high street lender or a challenger bank, we'd be borrowing at 12%. So immediately over a £30 million deal, we spent £3 million on finance over what a big player would. So I think scale is our barrier for entry on sheds.
Have you ever looked at refurb in a shed or an industrial site?
I mean, you could argue we have refurbished industrial, but typically to convert it to resi.
Do you think there's much scope in that though? Taking like, a decrepit looking sort of shed or industrial site and just going in, refurbing it, optimizing it, maybe extending it, adding another storage floor, something like that. You ever looked at those sort of deals?
The interesting thing about sheds is they have to comply with an EPC of a C within 2 years, and they're basically a bigger. Yeah, so let me pull up the. This might be one for.
Why on earth? What? I didn't know they had to comply with any EPC ratings.
So from April 2023, it needs to be up to an E. But I'm trying to find where, because there is another change coming in. But I mean, we're literally talking about a big old windy shed that needs to be improved. Its thermal. So I think there will be, whether it is a C or not. I think that obviously Class E, and typically like offices and things like that, do have to be a class an EPCC within 2 years. And actually, a lot of that's starting to come to light, whether the government push it back or not. But I do think there is a good opportunity for taking on sheds that don't perform very well from an energy performance and upgrading them. So obviously you have massive surface area on the roof, so putting PV on the roof. You're going to have to build some sort of prefabricated insulation units within inside. So I do think there's opportunity for upgrading, because your big players like the Amazons, like the anyone that's required, even builders merchants or whatever it may be, they will want an energy efficient space. So I do think there's a sort of upgrading the energy performance, but I can't see how you can get one of those buildings more efficient, because they've normally got big roller shutter doors on the front that are open all day. So
yeah, I don't understand what the need is for it. If you're storing, let's say you're storing timber, what's the need for thermal efficiency if you need to be in and out of there all day trying to fulfill timber deliveries? I had no idea that was a thing, mate. Didn't know industrial. I understand with offices where you've got people working in the office, but
so I think ChatGPT is helping me, and I've specifically asked about industrial. It says key changes, minimum energy efficiency standards MEES 2023 updates from April the 1st, 2023. All leased and commercial properties must have a minimum EPC rating of E or higher. Future updates, brackets planned, by 2027, the EPC rating for commercial and industrial buildings will likely rise to C. By 2030, the target minimum EPC rating is B, to align with the UK's net zero emission goals. And I completely agree with you. Like, how can you run I talked to a few episodes about how I worked at a turkey farm, and they had like a 10,000 square foot fridge, right? So that you're literally in this industrial building's fridge. Its leakage is shit show. It's got all these units pumping cold air into this space. How you can get that? I can't even get some houses to a C, let alone fucking a big old vast shed.
But also, just from a legislative standpoint, it makes sense that Resi has kind of a ubiquitous target because it's the stock that it's storing is human beings, and we all have the same requirements, and we need a certain kind of temperature and certain appliances and stuff that we use. Makes sense. But when you talk about industrial, you could be storing meat in a fridge, like you're saying, to timber, to aggregates, to Amazon, like. There is no necessity to look after those things other than by the person who owns the building is looking after their own stock. Yeah, it doesn't make any sense. Crazy. All right, another question. Talking about personal journeys scaling up, what worked, what didn't, and key lessons learned. So particularly to do with trying to scale or trying to get, trying to get bigger in any kind of way. What's a good learning curve, or what's a stumbling block you came across when you were trying to scale up?
I think Roger Hamilton, one of the writer of Your Life or Legacy personality profile, he always says the biggest bottleneck in any business is you. And I kind of do agree with that. If you look at some of the largest businesses in the world, it's where the CEO or the founder has a very, very defined purpose within that business and knows how to bring the right people in. And so kind of along the lines of that is almost like not imposter syndrome, but like belief in how it can be had. Like you kind of, when you start out, like for example, the first deal that Ben and I did, which was quite a big deal, 750k purchase price, 3.5 million GDV. When I actually look back at it, we were really good at what we did. We were really good in construction space, but we didn't believe that because it was our first deal. So it's almost like the tenacity to know to be self-aware and understand the risks, to have the confidence to do what you need to do is definitely, I would have said, a bottleneck to the scalability. We probably gave away more than we should have to start off. And what I mean by that is when we do developments now, we charge an acquisition fee and a project management fee because our business costs money to find it and to deliver it. When we started off, we didn't take that. We were like, yes, sir. 3 bags full, sir. We would do whatever the investor wanted and did and said, and completely bent over backwards to the investor to us was the holy grail. Obviously, we massively respect our investors, but we got to run a business. We got to find the next deal. We've got to deliver the next deal. So we have to build a sustainable business model that works for them and us. And actually, incrementally, that income that we're charging wasn't huge. So backing yourself in what you're doing, if you have the skill set, is definitely some advice that I put out there. Approach people that have been there and done it before you. Don't be afraid to do that. Like, it absolutely amazes me that I go live on mine and Ben's podcast every Friday, and we do this every week, and people just don't ask enough questions. Like, it's free to ask us a question that might save you hours. It might save you thousands. It might save you making mistakes, and ask those questions. And I was probably a victim of that myself, of not getting out there and leaning on other people that have been there, done that, worn the t-shirt, and actually can save you thousands of pounds or thousands of hours is hugely, hugely valuable.
I think to that point though, Jack, I think a lot of people struggle asking questions sometimes. And this is a known adage, but people don't want to look silly when they're asking questions, so people get nervous. Whereas you just gotta. I've never had that issue. Just ask any fucking question. Doesn't matter what it is or how stupid you might think you sound, and whoever you're talking to, no one's going to think you're stupid. You just got to fucking ask the question, because if you don't know something and you don't ask, or you don't get. And it's kind of that simple, isn't it?
Yeah, completely agree. What else is there? So it's often easy to get distracted. You've probably heard the phrase shiny penny syndrome.
Yeah.
And the phrase inch wide, mile deep, which is like your focus. I was definitely a victim of not shiny penny. I don't think I've really suffered that. I've kind of always knew what I wanted to do, and I've put delivery process into that, which is why our businesses are all growing. And there probably was the odd thing here or there that didn't hit the ground running. But what I would say is definitely focus on like specialist areas. If I could have our time back, I probably wouldn't have run the social portfolio to where it's today, and that would have given me time to focus in the other businesses. It's easy to say that because it was going really well, and then it didn't go so well. So I've learned a lot from that. And if it went really well, I probably would have said it was worthwhile doing. So you kind of have to trial and error a few areas. But if I didn't do that, I feel like all of our other businesses, development companies, Central Suites and XP Surveys, would be in a much better place now. So not necessarily just shiny penny, but spreading yourself too thin and making sure that you're giving the devotion of the time into the businesses and the pots that you need to. The way I see it is you are a watering can, and every business that you have is another plant. And you only have so much water that you can retain in that watering can every day to water those businesses.
Well, let's look at it from a scale, and I could talk from experience as well about some bits. So if you're running a business, any kind of business, and would obviously take property in this scenario, there's a few core functions that you have as the business owner, right? You've got strategy, which is pretty much always going to fall on your lap if you own and run a business. It's kind of on you where you're going to take and steer that business as the captain of the ship. So there's strategy. Then there are the scaling bottlenecks and functions that you kind of have to perform, and it's always going to start with you. You can delegate it later, but you'll have hiring staff and identifying what staff you need, so roles and responsibilities, and then systems and processes, and then feeding the beast, which is sales and acquisitions, or raising money. In our case, we'll put acquisitions into systems and processes. So those are the functions and where you're likely to find bottlenecks. So put strategy to one side, because you should know your strategy and stay away from shiny penny syndrome. If you've got a strategy that works, stay on the path. So many people get distracted in property, man. It's crazy how many people have something that's fucking working.
And if it doesn't work, but you think it's going to work, stick to it as well.
Yeah, exactly. But too many people in this game, we've seen it over and over again, where they've nailed something, it's working well, they're building a reputation, and then they go and try something completely different, and then they disappear, or they fail on it, and then they end up coming back to the thing that works. So, strategy, put that to one side. So then there's systems and processes. So when you're starting out, and this kind of comes together with identifying key staff that you need, which comes down to identifying roles and responsibilities. Roles and responsibilities work in tandem with what systems you have and what processes you follow as a business. So you need to get really good at identifying systems and processes that work your strategy. So for us, we use things like Monday.com, templates, checklists, different kind of documents and brochures and ways of identifying sites and appraising sites. What are your systems and processes for tackling the full length of the project cycle? You need to have that. I don't think you can get away with it. You have to have that mapped out cleanly, and then look for those 1% gains and start to improve those systems and processes. And from that, you should be able to draw roles and responsibilities, identify bottlenecks for where you need to hire staff. And that, to me, is probably the biggest bottleneck, which touches on your point, Jack, about most business owners wanting to do everything themselves, because they just don't get good at identifying what roles and responsibilities can be delegated to alleviate more time back to the business owner, to then put that into higher value tasks and either bring more sales into the business, increase the processes and make them more effective, or find new staff members to grow the business and the bottom line as well. And I think that's just where most people get caught. They just can't, they don't have the bottle to hire staff, or they can't identify exactly what staff they need because they can't read the roles and responsibilities off of their systems and their process. And I think that's probably one of the core functions why people can't scale. I don't know if you've got anything to add to that, Jack, in terms of just identifying the right staff members, which could be a daunting task, particularly in property.
Yeah.
You think someone needs a lot of domain expertise. I actually asked Jack the other day when I was with him, I was like, asking about how he found his acquisitions guy for his commercial projects and how he then manages those. And at the end of the day, Jack just had to train someone up effectively. And that's time and effort, and you've got to identify that, and then you've got to be able to put that energy in as the business owner to train that person up. So what would you say, Jack, about those scaling issues?
A really good exercise to do with the people is to set up what we call almost like an organization chart with everyone in the company today, and then an organization chart of everyone in the company when it's finished. And then you kind of know your roadmap of who to bring in where, and then create the job description off the back of that requirement list. So if it's an acquisitions guy, you know exactly what they need to be doing day to day. And if you mentioned that you brought an accountant in, if you have really close numbers drawn down in your business, you kind of know when you've got the bandwidth and the finance to hire that person in. So the scale of that is bringing the right people in. It all comes down to high value tasks and low value tasks. Like a high value task is bringing someone into the business that can take on X or Y, And if you do that job really well, it will then, give you 1,000x return. And James Sinclair talks about it himself. He said that, we're in this game where we're, first charge looking for 10%, second charge looking for 20%, whatever it may be. A member of staff can give you 1,000x return on their time and their skills that they bring into the business. And so definitely you wouldn't be able to do what you can do without the right team. And it's actually funny because a lot of our staff kind of forget that Ben and I did everything to start off, nowhere near as well as we can now, because we're well equipped as a team. But it starts off just you as the founder doing everything and bringing the right resources and teams in. And that doesn't have to be permanent members of staff. That can also be on a contract basis, whether you've got someone that helps with architectural design on a contract basis or helps with project management on a contract basis. That's sometimes a better way to facilitate that, because you're not so vulnerable to the sort of expansion and contraction of work that you may face. You might be delivering 3 sites and then none. So dealing with that sort of workforce to grow. I personally still feel that always the biggest limitation, the biggest limitation typically is cash. Like that is typically the biggest strap, because if you had the cash, you could go out and hire 10 people in a few weeks. If you have the cash, you can go and invest in that product that's better than your competitor. If you have the right cash, you can do that deal, you can take that contract, you can take that office space, you can do all of these sorts of things. And that tends to be the biggest limitation.
Just whilst you're on that, just because it's a good caveat that it does, but bootstrap founders, to your point that you and Ben used to do everything, same in this business. I used to have to basically run the show. When you're a bootstrapped founder compared to, more of like a corporate founder or someone who comes in with a load of money and just puts the team there, you have to learn every part of that business. And you're generally much leaner and more effective because of it, because you don't have the cash. So you're constantly finding time and energy and cost arbitrages, aren't you? Which makes you a more robust business, I think, than people who can come in with a few million quid set up from get-go, and they themselves as the founder don't even understand how those different parts of the business works. So there is an advantage in some ways to being cash strapped, but also it means you can go bust as well much quicker, because if you just don't have the reserves behind you.
Yeah, completely agree. And I would have said that if you, for an example, gave me, let's say you brought me a business and it's an aquarium business. Just try to think of something completely random.
Why not?
With an aquarium. If you brought me an aquarium business, I might have skills and knowledge of business fundamentals. So how do you run your sales, marketing, operations, finance, and team? I might have people in my network that can help with infrastructure, producing the sales, helping with marketing, helping with the finance. But if you gave that same business to Alan Sugar, he will scale that and grow that way quicker. And you see people on Dragon's Den that don't actually need money. They just go for the people that are sat there to help them as a mentor and an introducer, and to open the phrase you often hear is open doors. So don't neglect your network, I would say, is a key one. Your network is going to be the only thing that cannot be taken away from you, unless you do what Ryan said, like the other developer, and fuck a load of people over and fuck off to Dubai, did you say? So then your network might not be that. Your network is the only transferable product that you have, as well as cash, that can go into other industries and other sort of linears that you can utilize. So
yeah. So I think to round off the scale in the business sort of this discussion, which we'll do again with Dorian and Stu as well. But yeah, you need to know, when it comes to hiring staff, I think you need to know what the ROI is on that staff. So ultimately your job should always be, if you're wanting to scale, is to bring more business to the business in the form of sales, raising capital, new sites, whatever that function is. And you need to know how to increase that function so the business grows, and then what staff you need in place for those functions. But ideally, every staff you're bringing in has an ROI. You're not bringing someone in to cover a hole, which is what I think what quite a lot of businesses do, and we've fallen guilty of that at some points, and then try and pivot that resource around so they're actually then producing a net positivity, whether that's increased time back to higher up staff to then perform more high value tasks, or back to myself where I've then got more time and I can think of more strategy and bring more marketing and sales to the business. Like you kind of, it can be very difficult to quantify starting out. It's only once you go through and understand what a good staff member looks like once they're hired, trained up and perform that function, where you really know what the benefits are. And I think that's where most people get scared of hiring, but that's the limiting factor. If you don't hire, you just can't grow, because AI is not good enough yet. You've got to be able to have more resource and more manpower behind you. Yes, it can be a nervous thing to do, hiring staff, but at the end of the day, if you don't do it and you prolong it and you defer it, you're going to struggle to scale. So one last thing, and then we'll close out. So from the Chat GPT questions, I mean, yeah, the next question is given us to discuss how you build your teams, including specific roles like construction managers, letting agents, and how to handle growing pains. I mean, actually, it'd be good actually to follow on this. Just looking at some of the core managers that you've brought in, Jack. Those core managers, how did you identify their roles when you brought them in? Did they perform the role in the way you thought? Did you have to kind of pivot the role? Did you have to tweak it? How did you tweak it? Do you have anyone in mind in the business or any position you had to fill managerial wise?
Yeah, so the first role that we always hire in any business is like business manager or office manager in that business role, to help the day-to-day operations. Because what you don't want to be doing as a business owner is be dragged into the day-to-day operations. There's other more cynical roles like fee earners. I'll use our surveying business as an example. The way we grow our surveying business is we actually use the admin team in XP Property while we prove the concept in the surveying company. We obviously had a paid surveyor that was the fee earner, and we tried to 4x is a good metric, 4x his salary on what he could bill in a year. So we've got him producing the revenue. We actually had natural business development across mine and Ben's profile and the contacts that we had in our network. We then had an office manager managing that surveyor's day-to-day management, dealing with clients, dealing with invoicing, and that we lent on XP Properties resources to deliver that to a point of scale where we then had several surveyors in-house, and we could hire XP Surveys its own business manager that then managed the day-to-day. We then got to a point where we were very efficient at delivery. We had multiple surveyors on the books and multiple consultants that would help with it. We had the organisation and the administration dialed down, and then the next logical hire is a business development manager or someone that can bring in more sales. Now you can pay for that and try and do that digitally, which is how Ryan does a lot of his. With what do we call it, panels. Or you can bring someone in that can work with people, and that's what we felt was more beneficial in the architectural space. Someone that could go to their office, talk them through what we do, and try and win some business. So we then hired a business development manager. The way that is all formulated is you have, like I said, an org chart now, org chart then, how that growth changes. One thing that is really, really missed off recruitment and hiring is when you have that org chart, you have roles and responsibilities. The roles and responsibilities are exactly what should go on a job description, so that when you hire someone, when you put an advert out online, you are basically communicating all of the things that they need to do in that business on a sheet, and they need to then resonate with all those things. They can go, I could do that, I'd be good at that, I'd enjoy that, I'll do that in any company. So when you hire them, they're perfect for the business, not for you, for the business. And that's often missed. A lot of people believe in hiring good people, and I am a massive believer in that. If you meet a good person, you get a really good vibe from them, and they're a star. They could be a star in your business. That is really good, important to hire them. But then there's also other people in your business that are essential, and they're called the backbones. They're the people that just day in, day out do what you need them to do, and they keep the business going. They're like clockwork. They come in, they do it, they go home. They come in, they do it, they go home. We call those backbones. They're slightly different to the stars, and often stars have a higher turnover of ratio because they might want to go and do it on their own. So you built a job description. What you also do on top of that job description is describe exactly what they're doing. So for our business development manager, it will be bring more sales in, or how many sales you want, so that he knows that he's looking at visiting architectural offices, he's talking to existing clients, he's talking to new clients, he's going to events, he's putting expos on. But the principle of their role is summarized in a 2-liner that just says, bring us more sales, or hit our sales targets. And that is essentially their role. So if it means going all the way back into the office, going through some paperwork and finding that old client, they're not necessarily dragged down on their duties in that hiring. And then you hire them and you give them the right training that they need. You make sure that they understand the role. I'm a massive believer in carrot motivation rather than stick motivation. Carrot motivation is where you tell them what you need and then you let them get there. Stick motivation is where you have to keep motivating by nudging them in the bum to give them the right foresight. That is really time consuming, being a stick-driven person. And I would rather just sack them and bring someone else in that can be motivated by the carrot. And stars actually go beyond the carrot. They create their own next destination and ideas and solutions, and grow the business.
I really like this categorization you're coming up with here. Can we just summarize this? So you've got what you're saying is you've got the backbones. So the people who in a job interview, they'll be the people who go, I just really like supporting a team. Those are those people, right?
Yeah.
Who they don't want to be the star of the show. They don't want to take on risk. They want to have a regular system and process that they follow through. They want to get into a pattern and a rhythm, and they want to dial in and just support the team. And those are your admins, basically. There can be other functions as well, and you're calling those the backboners, right, of the business. And then you've got the fee earners, and the fee earners are your sales guys, they're your surveyors, the people who should be going out there, and they should be bringing in a multiple of their salary worth of business to the business. What do you call your managers? Do you just call them managers, like, if we're going to categorize them?
Yeah, I mean, we don't really have middle management in any of our businesses. We're what I would call like the Band of Brothers style company. So we're all of our outfits are between sort of 5 and 10 people. It's a very level playing field, so no one really has a senior manager. It's direct, is very flat structure. Ben and I are obviously still in that flat structure, so we're kind of working as CEO and in that particular role, but we don't necessarily have. We just have we employ a process where your area. So, for example, a technical project manager would never come to me to help him with admin or do whatever. He knows what he needs to do and he does it. So we have quite a high quality of employee, rather than senior management and then loads of low quality. But we do have a lead surveyor who manages all the surveyors. We do have the office manager who manages the surveying, the clients, the accounts, and all of the admin of that business. So we have quite a flat structure because we're kind of like pods of each different business. If we were all together, we would have head of development, head of surveying, but we don't. We are that.
Do you think you'll evolve into having those managers there, or do you want to keep it as a flat structure, keep it nimble?
Yeah, I can't see our development company growing massively more. I think our surveying business will grow. We want to take that to a national surveying business. We believe that we've got tech algorithms and we've put funds into the foundations of what we're delivering that are better than anything else done nationally. So we do want to grow that, which means we'll have regional managers, we'll have head of finance, head of operations, head of sales, and things like that. But yeah, in time.
And then where do you put these star players then? We're siloing the star categorization now. Where do you sort of put those people?
Yeah, I suppose they're still in roles. They're still in roles. Our EA is a star player. She's really good at a lot of things, and she's been in the business for many years. She started in XP Surveys and is now in kind of like the EA role. So she does manage staff to some degree, manage our business and our diaries day to day, manage outreach with investors and prompting us. Yeah, I would. Interestingly, a friend of mine runs a business, and a friend of mine's a recruiter. Another friend, and I tried to get him in to get the recruitment gig at this business, and he said that I think he was ops director is running the business, not the CEOs, the two CEOs, the ops director. And I think a lot of those star players that are in those roles, if you give them what they need and what they desire to do in those roles, they will stay there and do that for you. And it's quite common that someone else is actually growing the business and doing the day to day and doing everything you need, when the CEOs can be profile raising, capital raising, taking the risks. So I suppose in an ideal world, you want to put the star players where their return is amplified, right? You don't want to put them in a day-to-day routine, repetitious role. But there's more than one star player in our business. We've got multiple star players that do amazing things in our company. So, I'd probably argue 50% of our workforce are star players.
I appreciate what you're saying, though. You touched on it a little bit before, that the star players, depending on the position they're in, might end up wanting to set up on their own because they can be so good that they just know they could do this and path their own course. Which is always a risk for any business. But if they can give you, a good 2 years worth first and help boost the business, then they've kind of served their time, I suppose. So just to summarize that then, so you've got the backboners, the people who want to support the teams in the business. You've got the fee earners. They should be getting that multiple on their revenue and they should be growing the business. There's managerial staff who should be overseeing and making sure the business is running smoothly, staying on track, meeting targets, things like that. And then there's the star players who can kind of be in any given function, but typically they're in a higher value task or role that is improving that sector of the business and hopefully having a more of a universal effect on the business. So I like how you've categorized that, though. I've never done that in my head, like categorized it into those sort of sections. But it's when I think of our staff, I think of those people fitting those categories quite nicely. So yeah, hopefully useful for anyone out there. But growing a team is difficult. It's the hardest thing. It's the hardest job you'll ever have in the business, is finding the right people, because you can have someone who fits a role and does the job, and you go, cool, job done, that person's doing that thing, that's box ticked, right? But actually there could be someone out there who does it 2, 3, 4 times more effectively, or who brings new ideas. There's just so much more to it, and it takes a lot of time, doesn't it, and trial and error to bring in the right people. Human resources is
I've always been, my dad and other business owners have always said the biggest problem with scale is people. But he's come from a background where he ran a toilet hire company, and then a construction business, and a plant and tool hire company. So the typical people that he was employing are fairly low entry salaries, therefore very high staff turnover, very unmotivated, probably have been in other roles. And so I do agree with that. And that's why we've set up our business not as a construction business, so that the workforce is really lean for the output that we're doing. Because I do think it's difficult to grow teams really successfully. But, Dorian's done a great job of it. I think has he employed like 40% of Wales?
something like that. I think his headcount's 60 now. I think 60 plus, which takes him to the medium business size. And yeah, it'd be interesting to talk to him about his managerial structures when he's next on. But hopefully that's been a useful episode. Dive into some details there about all kinds of things in property. There's 7 more questions that ChatGPT has as well, so we'll touch on those in some other episodes. But yeah, big love. We release these episodes every Thursday, 5:30 a.m. Spotify, YouTube. Subscribe. Check out the Ground Up Network. Trust me, it is beneficial if you're in property. If you're listening to this, then you should be in the Ground Up Network just by default, because it will be so much more beneficial to your learning and your journey, and just accessing resources that we all use in our businesses. Very valuable. 7-day free trial. Try before you buy. Why won't you do it? But yeah, anyway, have a good weekend, Jack. Big love to everyone out there.
You too, mate.
See you next week.
Round up sound.